do have to change our forecast. So the assumption that we make is, or actually the fact that we know is the Strait of Hormuz is closed. Most economists will tell you a forecast of CPI and growth based on the assumption it reopens at some point later this summer. But what if it doesn't? So the way I sort of approach this is, for what we should price in is what we know. And we know that the strait is closed, and as each day goes by, the oil market gets tighter and tighter and tighter. And so you can see US inflation is currently around 2.4. This easily gets it to 3% just from the oil and jet fuel shock that you're going to see. The prices of flights are really going to skyrocket. In some cases, they've already doubled. Can you get beyond that is the big question. And this infects every other part of the supply chain. So it's a near-term energy shock, but it's going to feed through to food. It's going to feed through to plastics. It's going to feed through to helium. It's going to infect every other part of the metals and aluminum, steel, ceramics, cement, all those sorts of industrial metals and sort of industrial materials. So you're going to see house building costs go up, et cetera, et cetera. And that's how you can get to the 4% levels. But for right now, we should assume that we're at least going to 3% inflation. And if you want to hear a nice forecast, you listen to someone who says the war is going to come to an end soon, and therefore it will only be temporary. But we just don't know if that's true.
Right. So that's the inflation side, not good. How about the growth side of the equation, Jordan? How do you think that this war in Iran factors into global growth?
Well, we should never underestimate the ability of the world to rebound, and also the resilience of the US economy as well. It's in Europe where you've got the weaker links. Very easily, you can get a recession in Europe because the growth levels were around 1% anyway. So it's not exactly a strong economy to start with. But in the US, you were now casting between 3 and 4% GDP growth before this all started. Those nowcasts have already fallen to around 2% for US GDP. To get it in the sort of negative territory, you need oil to go to the sort of 150 to 200 range. It's only at $150 a barrel that you start to see the sort of demand destruction that is recessionary. So at this stage, we're talking about slower growth, but most economists, because of their assumptions the war is only going to be short, will talk about how Q3 and Q4 rebounds back.
Off presidential tweets, 115.07. This is the president. If Hormuz not open after deal, will blow up Karg Island. Jordan Rochester, one of my problems is I have a nominal GDP analysis, which is, okay, growth comes down, inflation goes up, we're at 5% nominal before, and we're going to be at 5% nominal after. My textbook says, no, that's not what's going to happen. Run us through the Jordan Rochester dynamics of the animal spirit of America. You can take it globally, what you see from Steve Risciuto, what you see from Dominic Constam, but give us the dynamic of growth and also at the same time the dynamic of inflation.
Well, everyone's going to talk about the energy shock leading to inflation going to, let's say, 3 or 4. Let's talk about those sorts of numbers. And then in terms of the growth story, whilst we can all get doomy and gloomy about this, there's still the AI structural trend of higher capex, and that's going to feed through even with the energy price spike. There's a problem with helium. So 40% of the world's helium supply is caught up in the Gulf right now, and that is used to cool data centers. But I don't think that holds back firms from investing in it with the models and the demand for AI, and also the pickup for it picking up as well. And then there's the fiscal spending. So the One Big Beautiful Bill, it was designed to help win the midterms for the Republicans, with fiscal spending increasing in Q1 and Q2. Scott Bessent has pretty much alluded to that fact very transparently. And so you're going to see the fiscal government spending improve. I think you'll see a rebound in the labor market as a result, but you're stuck with this higher energy price shock. So your nominal GDP growth will be higher. And then for equities, it's therefore earnings growth isn't as bad as people are fearing.
Jordan, we just had Mark McCormick with the Bank of Montreal, and he had a really important statement that what people don't understand in the different Japan narratives is 160 is the new normal. Do you still call at some point out there a stronger yen down to 150 to 140, dare I say stronger, lower?
No. So everything changed with this war, and the euro, the pound, and the yen all stand out as currencies that will really underperform versus the dollar. The US is an energy exporter. Japan's one of the largest energy importers. What we're going through is in terms of trade shock. The cost of their imports is skyrocketing, whilst their exports are not. Their trade balance is deteriorating. The fiscal deficit will get wider as the government also intervenes to try and shield the consumer from the costs of it. And there'll be extra JGB issuance. There'll be a wider trade deficit chasing dollars. So if it wasn't for the FX intervention risk, which the Japanese authorities are making loud and clear is still there, their finger is on the trigger to sell dollar yen, to wipe out speculative longs, we'd already be at 162 in my mind. So for us, it's going to be a bit of a grind to 162 with the ability for big drawdowns, 3% drawdowns. If they intervene, you get 3% moves in a day. It's pretty significant. So I'm short euro, long the dollar. I would do it in the pound as well, but I'm not doing it in the yen because I just don't want to fight the intervention risk.